think investors really need to stay invested because of all those cross currents that Steve just mentioned. The underlying fundamentals of economic growth, despite the variation in those indicators, are still positive. We're still seeing economic growth slower, but positive. And that's true globally, despite the fact that some of the countries actually have moved into recession. Manufacturing is weak, but services are strong. Consumers are still doing fine.
Right.
And job growth is strong. So I'd say investors need to stay invested and make sure that they're owning equities in this environment.
One thing that makes me a little nervous here, Kate, is that I read that you think people should look at international equities, emerging market equities. Yes, the valuations are attractive, but, sometimes they're value traps.
Yes, they can be. But when you look at the emerging markets benchmark, it's 33% in China. So if we continue to see China provide stimulus and try to stabilize economic growth and make sure that their economy is not slowing faster than what they want, then we're likely to see all of those stocks rebound on confidence that what we're going to see is better growth going forward, as well as those attractive valuations. If trade picks up, it's a catalyst for global growth. It's a catalyst for better growth in Europe as well. And that's why we're saying own international.
Well, and obviously, if trade picks up, then all of our problems are solved, guys. I mean, Kenny, would you say that's what this all comes down to?
I think it does. And I think all this nervousness of late is certainly all the talk about, that negative China data recently, the negative Eurozone data. But I think a lot of that gets blown out of proportion. So I agree with her completely that, listen, it's like anything. You just can't go out and buy a broad swath. You need to do your homework. You need to understand where you want to invest and what specific stocks within those countries you want to invest, unless you buy, the ETF, the emerging market ETF, which is more of a broad swath, right?
What do you make of the fact that the president called the heads of three major banks this week and talked to them about the economy and the yield curve and everything that's happening?
Listen, I think a lot of that drama that got started on Monday and the way that the market sold off, I think it demanded that somebody at least say something. I think he's trying to go out and, play that calming voice. But meanwhile, he's the one at the front of the chaos. And so it's interesting that, he creates a chaos and then he calls them all up to say, listen, everything's great. Don't worry about it.
Maybe if they all said, the main issue is, and you've done a lot of reporting on this, is it the economy, is it trade, blah, 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 blah. And it said a lot of the moves are down to trade and tariff concerns. We saw this in the consumer sentiment data this morning. It was trade and it was the Fed. Those got most of the blame. So do you think the president is open to hearing this feedback and coming up with other ways to be tough on China?
One of his advisors told me for about a half an hour a day he's open to that explanation. I do not want to be involved in the process of figuring out what animates the president of the United States. It's very plain that he passed an excellent tax cut that should have underpinned investment and consumer confidence. In addition, there was a big fiscal stimulus, the efficacy of which we can debate. But he is not reaping the rewards of those previous efforts. The stock market has been flat for 2 years. If you factor in an average 7% gain in the stock market over those 2 years, and you attribute the fact that we haven't had that over 2 years to trade, then trade has cost us $3.4 trillion. Okay? And that is against a intellectual property problem that Kudlow himself said over 8 years has been worth perhaps $600 billion. So the idea that we've traded one for the other, in addition to the idea that we won't necessarily reap future productivity or capital investment gains to the economy in the future, means that the problem is entirely out of proportion.